Okay, we are back and welcome to our final session of today's symposium. Year in and year out, those of us in the L&E group are honored to have colleagues from other specialties join us for this symposium, and this year is no exception. For our last session, we are excited to have Tim Goodman and Melinda Maher from our benefits and compensation group, and Mary Streitz from our tax group join us to talk about tax and benefits challenges ahead. We have been working closely with Tim and Melinda and Mary and their colleagues on the variety of issues that have come to the fore over the last few weeks, combining employment and benefits and tax issues. And that partnership has been much appreciated, I think, on all sides here at Dorsey and with our clients. And we are just thrilled to have Tim and Melinda and Mary join us for this last session. So Tim and Melinda and Mary, have at it.
Thank you so much, Ryan. Why don't you advance to the next slide? Real quickly, what we're going to be talking about here today, it can be broken into a couple of parts: legislative response to the coronavirus, the benefit plan impacts, and then the HR impacts at the end. And you can go on to the next slide here again, Ryan. So in terms of legislative response, I'm going to take that to start with in terms of retirement plans. The CARES Act made several amendments to the code and to retirement plans, and one of the ones in particular was to try and assist individuals who are affected by the coronavirus. The CARES Act basically created a change to distributions and two changes to loans to participants who are affected by the coronavirus during 2020. And as you can see here, in order to be a participant affected by the coronavirus, you had to fall into one of these categories. Either the participant, their spouse, or dependent needed to be diagnosed with the coronavirus, or the participant needed to have one of the following adverse financial consequences. First of all, an adverse consequence due to quarantine, furlough, or layoff, or reduced hours due to the coronavirus, or being unable to work or provide child care due to the coronavirus, or other factors as determined by the Secretary of the Treasury. I should note with respect to that last one, the Secretary of the Treasury has not issued any unique factors yet, but that could come forth in the future. If you are a participant and you are affected in one of these three ways, then the distribution and loan changes I'm about to talk about apply. If you were not affected, then these changes would not apply. So these are only for participants who meet one of these criteria. The good news is that as part of the legislation, Congress included that the plan administrator can rely on the employee certification, so the administrator does not need to look behind, so to speak, and see if this is really the case. And these changes apply to 401k plans, 403b plans, and governmental 457b plans. Could you go to the next slide, Ryan? So, as I mentioned, there are three forms of assistance provided to these affected participants. The first one, and this is optional for plan sponsors to adopt for employers to consider, is to allow a distribution of up to $100,000 this year in response to their need. That $100,000 distribution is optional. It does not have to be adopted. But if adopted and allowed, a participant could take up to that amount, and it would not be subject to the 20% income tax withholding that's normally required. And it would not be subject to the 10% withholding for early withdrawals. And it would also not be treated as an eligible rollover distribution. So it's in essence to allow a participant to quickly access money to use for an emergency and immediate need. With respect to this distribution, the participant would have an opportunity to have this either taxed pro rata over 3 years, or the participant could go ahead and recontribute it either to the plan or an IRA within 3 years. So in the ideal situation, the participant could then put the money back in and would not be taxed on it. Could you go on to the next slide, please, Ryan? The other two forms of assistance available both are with respect to loans under a plan. Many employers allow loans, and so the first one is a loan expansion that allows people to take more in terms of a loan out of a plan. So for the period from March 27th through September 23rd, a plan can allow participants to increase the amount that they have taken out as a loan under the plan. The loan dollar limit has been increased from $100,000, which was originally capped at $50,000, And the amount of the account that can be taken out as a loan has been increased to 100% of the account instead of the cap at 50%. With respect to this, one of the things that as the employer adopts this, they may want to consider allowing additional loans. So many employers limit the number of loans under a plan to one loan. Excuse me, if an employer has capped a limit in that manner, they may want to consider allowing a second loan in order to make sure that a participant could get at this additional loan amount. Finally, there's a loan payment suspension. And with respect to the loan payment suspension, the CARES Act provides that loan payments due between March 27th and December 31 in effect should be suspended. With again respect to these individuals who are affected, they have to raise their hand and say they've been affected. The loan payments are then delayed for a year, and that extends the normal 5-year repayment for most loans. And the loan payments then, when they are then due, will be adjusted for the interest during the delay. The plan sponsor will have to discuss this whole process with their record keeper. Actually, with all three of these, they should consider discussing with their record keeper. And the final point here on the bottom, it's very important to note that with respect to plans, normally the process is you discuss a plan change, you work on an amendment, you work with your record keeper to get in place. Here, record keepers are reaching out to their plan sponsors for direction on whether or not they want to implement these items, and the amendments will come later. Congress has granted additional time for the amendments. So those are 3 forms of assistance available, and that's helpful for the participants who have been affected by the coronavirus as earlier. The next one here on slide 74, required minimum distributions, is another change, but it is not limited to individuals who are affected by the coronavirus directly. This change is to go ahead and allow people not to take a distribution this year. Normally, individuals who have reached a certain age and are retired are required to start taking distributions from their retirement accounts. And in this case, the Congress has allowed employers to go ahead and suspend those required distributions. There's a couple of approaches here. One is to go ahead and continue with required minimum distributions and allow people to elect not to take them. A different approach is to suspend them, and then if an individual wants one, different individuals are in different positions, obviously, in terms of needing amounts from their retirement accounts. So this suspension is something, again, that you'll be wanting to talk to your record keepers about. If you could go on to slide 75, Ryan. So those changes that we just discussed all apply to defined contribution plans. Now we're going to be talking here about the defined benefit plans and some relief that the Congress has provided to plan sponsors who have defined benefit plans. The first type of relief was with respect to plan funding. As individuals with defined benefit plans know, when a plan is required to be funded, if it's not overfunded, there are quarterly contributions that are due, and Congress has pushed back these quarterly contribution dates as noted here. The one thing, if an employer decides to take advantage of this pushback in dates, is that additional interest will accrue from the original date until the amount is paid. In addition, Congress has allowed defined benefit plans to take advantage of their prior year's AFTAP, or Adjusted Funded Target Attainment Percentage. And the reason that's important is if an AFTAP is below certain levels, say if it's below 80% funded based on the AFTAP percentage, or if it's below 60% funded, plans are then subject to certain restrictions, first in terms of being able to make lump sums, and then in terms of being able to make certain benefit accruals. And so plan sponsors may wish to go ahead and take and use their prior year AFTAP statement instead of the new one, depending on how that comes out, depending on the end of the plan year and where funding was at for the plan year. Okay, so those are changes with respect to defined benefit plans. Could you go on to the next slide here, please, Ryan? Finally, one more change with respect to defined benefit plans, and this will affect very few entities, but I will mention it anyways because it was in the CARES Act. There's a special type of defined benefit plan grouping known as the cooperative and small employer charity pension plans. Those plans are subject to special rules in terms of their funding requirements and PBGC premiums. The CARES Act slightly expands the group of plans that qualify for this CSEC plan treatment. Not by a great deal, but that if you are a CSEC plan, you have more favorable treatment both in terms of funding and in terms of the PBGC premiums. So those were the changes made by the CARES Act with respect to retirement plans. I'm going to go ahead and turn this over to Melinda now to talk about some of the changes made by the CARES Act with respect to health plans. Melinda?
Hi, everyone. So my job is just to briefly touch on kind of what this pandemic legislation has done with respect to employer-sponsored group health plans. So right out of the gate, Congress and the president said, you know, under the FFCRA, that plans must cover products and services used in testing and diagnosis of COVID-19 without cost sharing, without prior authorization. And we've gotten additional guidance on that, but it's clear that there can be no kind of medical necessity analysis that normally plans would do or TPAs would do with respect to this testing. The cost sharing, you cannot apply deductibles, you cannot apply coinsurance, you cannot apply copays. And in fact, there will be no balance billing to the member with respect to this testing. I do want to emphasize that the testing, that it is with respect to products and services used in testing and diagnosis of COVID-19. We are not talking about treatment. There was a little uncertainty about that right out of the gate, but it is clear that the mandate is with respect to products and services related to testing, not related to treatment at this point. This does apply basically to all of your major medical plans. It doesn't apply to retiree only plans or other accepted benefit plans, like short-term limited duration plans, but otherwise it will apply to most group health plans. And also it applies to individual coverage. It applies both to the self-funded plans and to the insured plans. So we can go on to the next slide. So the FFCRA had talked about a limited type of test. The CARES Act came out later. And let me mention the FFCRA mandate was effective as of March 18th. So the requirement to cover the testing is effective as of March 18th. The CARES Act came out a little later, gave us more guidance as to what type of testing should be required. I have definitely seen a lot of confusion in the marketplace about testing. I think we have all seen the press on this and how there's a lot of there are a lot of struggles with respect to the testing and what testing is available. And I think we will see this develop. I have had clients concerned about what to cover because there is a push from certain vendors to get their test covered. I often have interaction with the TPAs on this basis because they are on the ground and they are, my experience has shown that they are monitoring what testing is available, what is appropriately to be covered and what isn't. But this is a fast developing area. I think we can go on to the next slide. So the CARES Act on this slide talks about, we talk about how it is to be covered, and the CARES Act gave us additional guidance on that. And then we also have additional FAQs from the tri-agencies, that's the IRS, the Department of Labor, and HHS with respect to how the coverage is provided. And basically what they've told us is that the providers are required to post the cash price for the tests on their websites. And unless we have negotiated a rate with the providers, that is the price at which we will cover the testing. I think this is going to be a somewhat problematic area as this goes forward because these prices may be high. I haven't seen any discussion yet specifically on this because I think the testing is still rolling out, but I think we will see some perhaps high prices in this area potentially. And as of now, plans are required to cover this even for out-of-network providers with no balance billing, no cost sharing. As I mentioned earlier, it's important to remember that we are talking about the products and services related to testing, and we are not talking about the coverage of treatment. We don't have a mandate with respect to the treatment. What we do have is something that is mentioned here on the bottom of this slide, which is guidance from the IRS that says we may cover treatment and testing without jeopardizing HSAs. So that is helpful. So we have the mandate to cover the testing, and we can in fact do it under a high deductible health plan without jeopardizing a health savings account. And we can even go so far as to provide first dollar coverage for treatment under a high deductible health plan without jeopardizing an HSA. This is based on the guidance from the IRS Notice 2020-15. Somewhat interesting, there is just no actual statutory underpinning for this other than basically the IRS and the administration, I think, want to encourage, obviously, not only the testing, but also the treatment for people to be able to get treatment on a easy and low cost basis. What I would say is my experience is the treatment, as far as I can tell, continues to be provided in the way that other treatments are. So what I have seen is most group health plans obviously covering treatment, but still subjecting it to the normal cost sharing that would apply. I think we can move to the next slide. So a couple of other items that the CARES Act provided for us was that they now allow for the coverage of menstrual products and over-the-counter medicines. You may reimburse those under an HSA, an FSA, and an HRA. Some of you who have been in this area for a while will remember that we were able in the old days to reimburse for over-the-counter medicines. That was taken away essentially as part of the Affordable Care Act in order to raise money. We have now been given that back apparently. So now FSAs can reimburse the over-the-counter medicines, and it does not require a prescription. Another a change from the CARES Act is that we can provide cover telehealth in a high deductible health plan without cost sharing. And I would say that I have seen this, I have definitely seen this taking hold right now in the industry. There is, it seems like an enormous amount of care, or much more care happening now via telehealth than happened before. We have waivers now enabling providers to provide that much more easily. The HIPAA constraints are no longer there. There are waivers for that. So the telehealth, it seems to have taken a hold, and I definitely have seen a movement among plans to cover this without cost sharing for the time being. I would say it's on a limited basis, usually for say like the next 90 days, kind of taking that approach on a wait and see, and maybe extending it beyond that if necessary. We can move to the next slide. And finally, we have gotten guidance, which I think is helpful, to say that you can provide COVID-19 testing under an EAP without jeopardizing the status of that EAP as an accepted benefit. And this I have seen used by employers to provide the testing to their employees who aren't otherwise enrolled in a health plan under the employer-sponsored health plan already provided, or perhaps have elected not to enroll. So this is a nice, if an employer is interested in covering that testing, it can do so under its employee assistance plan, and does not jeopardize the status of that EAP as being an accepted benefit, which is very important from an ACA perspective. So this was nice guidance. I think you are not required to do that as an employer, but if in fact you want to do it, it is nice guidance to enable you to do it under this EAP idea. So we can move to the next slide. And I think at this point, I'll turn it over to my colleague, Mary Streitz, to take you through some additional parts of the CARES Act.
Thank you. Hello, everybody. This is Mary. Can you hear me?
I can hear
Yes,
you.
Mary.
Good, thanks. I'm going to cover first a very somewhat modest provision in the CARES Act that expands the definition of permissible employee educational assistance provided by an employer on a tax-free basis to include student loan repayments made by the employer in 2020. So Section 127 of the Internal Revenue Code is a provision that says employers can provide employees with up to $50 to $150 a year in tax-free educational assistance benefits. The employer gets a tax deduction even though the employee does not recognize income. And an additional category was added to the benefit for payments in 2020 of student loans. Next slide. Next slide, please. Thank you. There are a lot of payroll tax credit provisions, more significant than the one I just talked about involving educational assistance, that are worthy of some discussion. First are the credits available under the FFCRA. Essentially, any sick leave and family leave wages required to be paid by the FFCRA are creditable against the 6.2% Social Security tax portion of the employer's share of FICA. So you don't, in the end, have to pay for these wages. You're reimbursed for them by the federal government. But if the credit exceeds the liability, you get a refund from the federal. Next slide. Before I go on though, I do want to discuss a few nuances of the credits under the FFCRA. They're also available for the allocable share of employer health plan expenses relating to those sick and family leave wages, assuming the health care plan expenses do not give rise to income for the employee. The wages are also not subject to the employer share of Social Security tax. The wages are subject to the employer share of Medicare tax, but you get an additional credit for those Medicare taxes paid. So rolling through those credits, there are some sort of hidden gems in there to be aware of. Now, the other one that the CARES Act provided for is called the Employee Retention Credit. Like the FFCRA credits, they're credits against the 6.2% Social Security tax portion of the employer's share of FICA, and they're refundable. But you don't get reimbursed fully. You get reimbursed for up to $10,000 of wages paid to employees that qualify for the credit. 50% of up to $10,000, which means the credit caps out at $5,000 per employee. The wages that qualify are also include the allocable share of health plan expenses as with the FFCRA. Now, figuring out whether the credit applies requires you to understand some additional intricate rules. that are different depending on whether the employer has more than 100 full-time employees or 100 or fewer full-time. And in counting employees, aggregation rules apply to related parties. So if you're a larger employer, you don't have as easy a road to qualify for these credits. These credits are available to larger employers for wages paid to employees who were not able to provide services due to the emergency as a result of a government suspension or partial suspension order, or as a result of a decline in any quarter in 2020 in the employer's gross receipts of more than 50% compared to the same quarter in 2019. So the employer has to be both adversely affected in one of these two ways, and the payments must be paid to employees who were not able to provide services. And this could cover wages paid to employees who couldn't provide all of the services for which the wages would ordinarily have been paid. So people who are sort of underutilized, I think, might have wages that trigger this credit. A lot of clients are asking questions about, their more intricate fact patterns. If an employer has a decline in gross receipts, and that's the reason they qualify for the credit, they would no longer qualify after the quarter in which the gross receipts return to 80% of what they were in the same quarter in the prior year. Again, intricacies. For smaller employers with 100 or fewer full-time employees, the same circumstances must exist for the employer, the government closure or partial closure or decline in gross receipts, but the credits available for wages paid to any employees in these circumstances, even if they're able to work. The purpose of the credit is to incentivize employers to keep employees on the payroll, if they can, by subsidizing a portion of the wages paid to the employees with these refundable tax credits. Next slide, please. There are exceptions to the retention credit availability. One significant one is that any employer who receives a PPP loan wouldn't be eligible. Governmental employers, federal and state and local, are also not eligible. The credit applies to wages paid from March 13 to December 31, 2020, in circumstances in which the credits are otherwise available because all the other requirements are satisfied. Next slide, please. So some procedural matters that apply to both the FFCRA and CARES Act credits. They will be claimed starting in the second quarter on the Form 941, even if the credits relate to wages paid in the first quarter. There's also relief from failure to deposit penalties imposed if the employer holds back deposits in anticipation of the credits. You have to hold back amounts that are correctly anticipated as of the time of the deposit, the wages credits to which the employer is entitled as of the time of the deposit. And the employer can't have sought payment of an advance credit by filing the Form 7200 which is a different approach to dealing with applying for credits in advance. Usually holding back deposits is going to result in a better outcome as far as the timing of receiving the financial benefit of the credit. The withholding of deposits can be with respect to any employment taxes and any FICA and federal income tax withholdings, not just the tax against which the credit applies, the 6.2% share, and that's because the credits are refundable. So you're going to get that money back so you can withhold deposits to the extent you're going to get that money back. Next slide. And then finally, the CARES Act provides a significant ability for employers to defer deposit and payment of the 6.2% employer share of Social Security taxes. Essentially, for any taxes that were due to be deposited or paid from and after March 27th of 2020 through the end of the calendar year, you can wait to make those deposits and payments until December 31 of 2021 with respect to 50% of the taxes, and until December 31, 2022 with respect to the remaining 50% of the taxes, which is very, very substantial tax deferral when you think of deposits that might otherwise be required, as often as a couple of times a week. But if you have received loan forgiveness with respect to a PPP loan, you are not eligible for this deferral.
So thanks for bringing us to that DC plan slide. But before I get into it, Mary, I was just going to follow up with you about some of the payroll tax credits for a minute or two here. I mean, I've also talked to employers about this, and I think that for the, especially the employment folks on the phone who may not deal with payroll as much, it's always amazing to me how important payroll and complicated payroll can be. And so, and feel free to add your comments to this, but I think that if you're with all these things, you'll want to be working very closely with your payroll vendor in terms of trying to work through how you'll be claiming any of these credits. And as Mary pointed out, a number of these programs and credits mean that if you use one, you're not able to avail yourself of some of these other options here. So I think that it's important. These credits can add up to a lot. Obviously, if you are subject to the FFCRA emergency leave provisions and you are paying people out, these credits are designed to then reimburse the employer or take care of the employer, so it's not out that money. But these credits are not the easiest to understand. I would be the first to say you have to look at the fact that how much you're paying to the person, what Social Security taxes are due, what Medicare taxes are due, and then what you can claim in credits, and just even at that point, working through that with your payroll provider and making sure you get that right, and whether or not you're taking these as offsets as you go, or if you're claiming them at the end of the calendar quarter. There's a lot, even if it were just for the FFCRA payroll credits, but as Mary kindly went over, the CARES Act expanded on different options for employers. So you also have the retention credits, and you also have then the deferral and the deposit and the payment of the employer portion of Social Security taxes. So Mary, have you, I know you've talked to some clients about these issues. I mean, one of the issues I would think a client would want to talk with someone about is if they might be eligible for multiple of these programs, just the interaction of these and which program might be the best for them in case it means that they wouldn't be able to take advantage of one of the other options.
Yeah, I think PPP is more generous to the extent you're going to get loan forgiveness. But as we've read, it's very hard to get that PPP loan. Another comment I think I'd make just about the payroll service providers, the people you deal with directly probably are not the people who are combing through the statute and regs and guidance and really fully are on the train as far as understanding all the complexities. So, you may want to get other experts involved in deciding on a plan that works best for you. One question I got was from someone who had applied for the PPP loan and wanted to withhold deposits while waiting to see if they got the loan. And I advised that person that because of the uncertainty, even with respect to how his employees would be counted for purposes of the PPP, he would have had a reasonable basis for delaying, taking a wait and see approach for that period of time before it became clear whether he was going to get the PPP loan. But we do know there's going to be another round of funding, and I think that reasonable cause arguments will be available to folks, even though that particular issue was not addressed in the guidance that talked about when you won't, when you'll get automatic penalty relief.
And Maher, you can correct me if I'm wrong here, but one of the reasons I think we've always encouraged people to make sure they're making these deposits is there's the possibility of personal liability for failure to make these types of deposits with the IRS. And so in thinking forward to, if you're going to be taking advantage of these delays, if you're a business that's in a more difficult position, you'd want to double check yourselves in terms of would you really be able to make these in the future rather than run into some trouble in the future with having failed to be able to make those deposits. Am I right about that?
You are. You are. Now, this is an extraordinary time, but I would say it would be very difficult to not, to have so much uncertainty that you weren't even sure you could make the 50% payments when required. And that is a long deferral period, and one for which, you really need to respect the importance of eventually making those deposits.
Yes. The final thing, I'll just mention, and then we can go on to a little bit about the impacts and stuff here. The thing I guess I'd say is that the IRS has posted a couple of FAQs, I believe one for the retention credits and one a much longer one with respect to the FFCRA emergency leaves. And like the DOL guidance that they've posted about the FFCRA emergency leaves, which has been updated multiple times, the IRS has already updated its guidance once on that FAQ page. I think when you print out all their FAQs on the guidance, it's like, at least on when I print out, it's like 12 to 15 pages long. There's a lot of information there. But, if you're not regularly dealing with payroll and stuff, again, this is something where, maybe some of the issues in terms of timing of the 941 or so forth, or whether you might take an offset there as you go, that's one thing. But I think otherwise you may want to talk to someone who's looked at all the statutes in terms of discussing these issues. So, okay. So Ryan, what I might ask you to do is, yep, there we go. Perfect. Thank you. We're on slide 89 now. And we're going to talk a little bit here about, well, what's the impact of all this? And I should say thank you to Mary, because payroll is the biggest thing for so many employers. It's a very complicated thing. So thank you, Mary, for walking through all that with us. In terms of the benefit impacts, with respect to the defined contribution plans, employers are contacting us about a lot of different issues. And one issue that's coming up is if you're an employer who's having to go ahead and terminate individuals, one issue you have to be mindful of is this rule that's called a partial plan termination. If an employer has terminated 20% or more of its employees over a period of time, then that employer has likely had what's known as a partial plan termination. What that means is that the employer needs to vest any of those employees who terminated so they would not have an invested amount forfeited. What this does is it results in a reduction of forfeitures under the plan. So there's a lot more detail here, and I'll just give a little bit of it. Is in essence, let's say that you have a workforce of 1,000 employees, and over a period of, say, 6 months, you end up terminating 250 of those employees. With respect to any of those 250 employees, if you have a vesting schedule and someone was terminated and their account wasn't fully vested, you need to vest those people in their amounts. And this is actually something that's very easy for the IRS and DOL to review, because of the Form 5500 will show how many employees you had at the start and the end of the year. So a little more information there, but that's something to keep in mind. Employer contribution reductions. We are having a lot of employers ask us about reducing their employer contribution for this year. And the idea behind that, of course, is if you're trying to figure out where you're going to spend money, you'd probably rather spend money keeping your employees employed than making an employer contribution if you're trying to weigh things. The ability of an employer to change that employer contribution really depends on what type of plan you have. And so a couple of notes here. If your plan says that you have a discretionary contribution and it's truly discretionary, that probably puts you in the best position to quickly change that. If your plan specifies the amount of your contribution, and many do, you'll need to talk to your vendor about getting that specified contribution amount changed. And thinking about how quickly that can be effective as of the current payroll period then. In terms of other plans, though, a number of employers have what's known as a safe harbor plan. These plans are designed to assist the employer by not having to do what's known as non-discrimination testing with respect to contributions, both employee elective and matching contributions, also referred to as the ADP and ACP tests. In order to stop a safe harbor contribution, generally an employer has to give 30 days advance notice of that. So there, an employer is looking at a much farther out period of time before they can cease that contribution, and they'll want to make sure they talk through their vendor again with the issues there in terms of getting that amended to cease that contribution and providing that notice so that they can get it terminated 30 days after the date of the notice in terms of the amount of the contribution. Finally, although fewer employers have these plans these days, there is a form of plan known as a money purchase pension plan. And there, an employer has to actually provide a 45-day notice. It's known as a 204H notice, generally speaking, to employees if they're going to be reducing the amount of the contribution. So employers need to review the type of plan they have and what it says, and then they'll have to adopt a plan amendment and often provide notice to employees that they're changing their rate of contribution. All that requires you getting down into the details of the adoption agreement and plan provisions, and then working through that with the counsel or your vendor to make sure that you get those changes implemented properly. Could you go on to the next slide, Ryan? Additional things that are going to happen from all this, and even if you don't make a change in the employer contribution, I think employers are going to have to think about the ADP and ACP non-discrimination testing. So this year, it's very likely that employees, given uncertainty and other factors, are probably going to be decreasing how much they're contributing to retirement. And that might mean that the people who are still contributing are more highly paid. That will then make it more likely that a plan will fail these testing requirements and result in the employer having to potentially distribute out money to highly paid people. That's something that an employer will want to try and start thinking through at some point here, including whether it might want to try and put some sort of cap on the amount of contributions being made by highly compensated employees to avoid some of these refunds. In addition, an employer is going to want to think through the investment and fiduciary duties by reviewing plan investments, especially if it has employer stock. If a plan has employer stock in it, I think it's really appropriate for the fiduciaries to review what has happened with that employer stock and to make a determination that it's still appropriate, if it is appropriate, given what's happening in the market, given what's happened to peer groups and so forth. Could you go on to the next slide, Ryan? Employers with defined benefit plans also have considerations here. Again, they have to worry about a potential partial plan termination, similar to as discussed under the defined contribution plans. But their other two concerns are really plan liabilities, which tend to go up in low interest rate environments, and plan assets, which, depending on how a plan is invested, could be differing from plan liabilities and causing impacts on financial statements and requiring future funding. So with that, I'm actually going to turn it over to Melinda to talk a little bit about potential impacts that are occurring with respect to health plans. Melinda?
So on slide 92, you'll see we've listed what we view as some of the potential impacts. Of course, there is the potential for a cost increase to the plans due to the increased cost of testing for coronavirus and treatment. God forbid you're an employer who has an episode of the disease crop up across many employees. Obviously, it could contribute to increased cost. I think that the converse side we are seeing at this point is actually delayed treatment, deferred treatment. So, and that will contribute to a decrease in cost. Query when, the stay-at-home orders are lifted, what is going to happen with that? There will be obviously some pent-up demand there. The other area that we've seen a lot of conversation about is how to treat the furloughed employees with respect to the health plan. I do have a number of clients who are continuing to provide health coverage to their furloughed employees. And something to watch out for there is to make sure that you do not run afoul of your Affordable Care Act requirements when you furlough your employees, if in fact you do not continue their active employee health coverage, just making sure that you are not going to run into potential penalties with respect to that. And finally, don't forget your obligation with respect to communicating on your plan changes with respect to the COVID testing. We did get a little relief in terms of not having to do a 60-day advance notice with respect to our plan changes on this, but it is a good idea to distribute a summary of material modifications to the extent you make the changes that you are required to with respect to the COVID testing. So don't forget to do that.
Say, Mary, I might turn it back over to you. It looks like you had one thing you'd like to clarify about payroll briefly.
Yes. Your question about the trust fund tax liability, that really isn't a concern with the deferral, because the only deferred taxes are employer taxes, the 6.2% employer share of FICA. Now, credits, you can withhold deposits of certain things to the extent you're going to get credits, but those are reconciled on the quarterly 941s, which are filed much more contemporaneously. So I don't think that officers and directors and responsible persons have to quake in their boots about these deferral provisions. And I apologize for not thinking of that right on the spot.
Well, and Mary, you have no need to apologize. I was just trying to think through it myself. So thank you for that clarification. If you want to go to the next slide, Ryan, we have just a few minutes left here, so I'll go through these quickly. The next two slides talk about some fringe benefits that we're seeing people ask about, and there's just a little bit of information here in case any of the employers on the line would like to delve into these more. Some employers are considering, if they do not have them, setting up disaster leave banks or medical leave banks. There are rules about how those operate, but they allow, in essence, employees to donate leave and then other employees to use that donated leave, not as cash, but as actual leave time, to assist them in both if they're ill or in recovering from a disaster. In both cases, the employer administers that, and a plan document is required to go ahead and provide the terms of it. I've given the sites to the notice and rev rule that address those, but I'd say it's probably helpful to talk to someone and set that up just to understand it if you are interested in it. Then Ryan, if you'll go on to the next slide. The other thing, we've gotten some questions about our qualified disaster relief payments. You may be hearing about these because in essence, these payments are not subject to federal income or employment taxes. these are not too good to be true, but there are certain rules that apply to these. And now that every state, I believe, has been declared a major disaster, these payments would be available to employees who are affected by the coronavirus. But an important aspect here is to think about how an employer is going to go about using these and the reasons behind them and how they tie out to the coronavirus. So that's something, though, that there's been some interest in. Again, I'd suggest talking to an advisor or counselor about that if you're looking to adopt it. Finally, if you'll go on to our last slide, Ryan. The last thing here, we'll just leave this for you folks to think about, but you know, today is maybe not the day, but within a month or 6 months, we'll be starting to see what does this whole event mean in terms of our workforce, right? In what we saw back in 2008, 2009, and in the subsequent years was a number of different changes occurred. Number one, people became more reluctant to retire. So people who thought they might have been ready to retire because of the shock to the system all of a sudden reevaluated and said, well, maybe I should stay on an extra 2, 3, 5 years because I want to really be prepared to retire. So it's likely that you're going to see your workforce demographics change as a result of this event. And with that, if you have an aging workforce, you're more likely to see maybe increased healthcare costs over the long run, maybe increased PTO and vacation accruals. And as mentioned during some of the other presentations, one of the other things you might see is just in terms of employees, the requests about working from home and different benefits and issues that could come up with that. So we'll leave those last slides for you as basically information points. And I will apologize, we've gone through a lot of information, but we wanted to get this out to you. If you do have additional questions, you should reach out to the people you work with, I think, and follow up on them more. But hopefully this provides a background on both the payroll tax and benefit issues related to the coronavirus. Ryan?
Thank you, Tim. We are at the end of our time, and let me extend my thanks to our panel members for sharing their expertise with us. A lot of great information, very timely and very important to our clients. To those of you who were participating afar, thank you for listening. Thank you for being with us. We, on behalf of the firm and the L&E Group, we are very grateful for our clients and the loyalty that you have showed, and certainly grateful for the opportunity to speak even remotely with new people. And so we truly value this opportunity to share what we've been learning over the past few weeks with you all. A couple of housekeeping matters. Recall, if you do need credit, please return your completed sign-ins to attendance@dorsey.com. And as Tim and others have said, if you have any questions, and we all suspect you will, coming out of this session and as we continue to muddle through the coming weeks of the pandemic and its fallout, please do not hesitate to reach out to any of us who've spoken today or other contacts at Dorsey. We would be happy to talk to you about those things. So again, thank you for spending your morning with us. We truly do appreciate it. Enjoy the rest of your day and stay safe. Thank you.